For those who have dialed in already, thanks for joining. Please give us 1 or 2 minutes before we start our presentation today. Let's start with the first poll for a small icebreaker before we begin the session. I think today the turnout is really high. We have actually more than 300 people who have applied, who have registered, and we feel like this is a very exciting event upcoming, learning about what investment is all about. We are actually very curious to know how you found out about this webinar. I think in a few moments, we will start to share the results of this multiple choice question. Hope everyone had a great dinner, feeling full, and now maybe it's time for a bit of learning on a Wednesday night, and we feel very excited to be able to share this amazing Wednesday night with you as you invest in your own knowledge. So I think without further ado, we will start to, we'll begin the webinar proper. So good evening, ladies and gentlemen, fellow supporters and investors at iSTOX, the supporters of the Compounder Fund and friends and family of Ser Jing, and those who are just purely interested about what this event. So the event today is an investor strategy in a post-COVID-19 world. And the reason why we designed this event today for you is because we feel that there's so many uncertainties happening around the world, and it's good to learn from the professionals, to know what it's like in their mind, to dive deep into their frameworks and mindsets, to really understand how we as investors can start to react or start to position our own investment strategies according to what's happening in the world around us today. So before we begin, I have a few disclaimers. So the first disclaimer is that this is not an advertisement event making an offer or calling attention to an intended offer. The information is purely educational purpose and has not been independently verified to ensure its accuracy and fairness. So even later, for some housekeeping, when you ask questions, try not to ask questions about single stocks, for example, what price do you think Snowflake will become tomorrow and things like that. I think the questions you should be asking is maybe more about somebody's mindset or what's the current overall macro scenario. I think that's a very good discussion point that we can go talk about later. So before we begin, right, I want to introduce you to a very distinguished speaker today who is also a friend that I've met and really respect. His name is Ser Jing. So I'll give you a small introduction about Ser Jing. His investment journey began more than 10 years ago when he started investing, started having an interest in it when he bought the wrong book, and the book is Common Stocks and Uncommon Profits. This wrong book, however, led him to the right path because he started to invest in his family's wealth, and in 2012, he graduated with an engineering degree. But instead of going down a path in engineering, he actually took the leap of faith. He left his job after 3 months to join the Motley Fool. And over 2013 to 2019, this 6-year period, he was able to be the co-leader of the investment team there. And his flagship newsletter by the Motley Fool called the Stock Advisor Go actually outperformed the global equity indices by 2 times over a 3.5-year period. So fast forward to 2020, Ser Jing actually took another leap of faith where he became a professional portfolio manager, and he's now the co-founder of the Compounder Fund together with Jeremy, his partner. So I'll also introduce to you a bit of background with the Compounder Fund. It's a very new fund, actually started in 2020. Their focus is long-term investment in global equities. The strategy they have is actually to find compounders. So what does compounders mean? It's actually a portfolio or single stocks that have high potential in returning strong returns over the long run. They are able to do so by employing strong fundamental analysis and holding onto these shares over a long period instead of trading in and out of those shares. Ser Jing and Jeremy view their fund as more than just a business. They not just want to return their value to their shareholders or their investors, they also want to help society. So one thing that actually drew me to reach out to Ser Jing a few months back is that one key pillar is that his fund actually aims to give back to society. And by giving back to society, it also means that they generate a proportion and they commit a portion of their income and profit to giving back, in terms of giving back purely to societal purposes like charities and stuff like that. So maybe later, Ser Jing will give you more context about this amazing fund that he's speaking today. So this event is actually our first event in the ADDit Investing Academy. A bit more about ADDit community is that we are started by this company called iSTOX. We are sponsored by iSTOX, and our vision at iSTOX is to give equal access to the financial markets through a regulated, transparent, and community-driven platform. So how are we able to do so? We do so by allowing, using our product, investors like you to invest in private market investments. So think about private market investments as something that is not often heard by common people for now, but actually is something that people will have access to in the future through iSTOX, like private equity, hedge funds, as well as unicorn startup investments. Next slide, please. So we are able to do so with our product. So this is a very high level and short preview of our product. In our product, right, you can invest in primary offerings and trade these offerings all in one place. So for example, there's a real estate fund. You can actually invest an amount. It's a fractional amount. So the minimum is really low compared to what the ultra high net worths of today have to do when they invest. Their investment size is around 1 to 2 million, but with iSTOX, it's much cheaper. This is enabled by our technology. And once you invest in these so-called illiquid funds, we are able to provide a form of liquidity through secondary trading in the market. So this innovation, we are very excited to give to the market. It's something that has not happened in the mainstream markets today. Next slide, please. So at iSTOX, we actually have a limited offer called the Future Now campaign. So I'll leave it as that. We are currently open to accredited investors only, and you will get an investment voucher when you choose to open an account. Next, about ADDit Investing Academy, because this is the first event. I also do not want to spend so much time talking about the community for today, but because the focus is actually on learning how to invest. So at a high level, our community aims to educate, help people to network among people who want to learn about investments, as well as empower you to make decisions when it comes to private market investments. So if you have any interest in joining us, to stay tuned and learn more, just reach out to us at community@iSTOX.com. Without further ado, I will pass the mic over to Ser Jing to give you a wonderful explanation and event about what his mindset and framework is when it comes to investments. Ser Jing, please.
Hi everyone, so give me a second to just share my screen. All right, hopefully you guys can see my screen carefully. Okay, so maybe I shall start today. Thank you everybody for taking the time to join me today. And before I begin, I just want to thank Nigel and the wonderful iSTOX team for inviting me to present at this webinar. iSTOX is, I think, doing fantastic work in democratizing access to great investment products and also in promoting financial literacy. So I'm really glad and honored to be a part of this webinar today. So before I begin, Nigel has already shared a disclaimer, but I also need to mention again that whatever I say here today should not be seen as a recommendation of any stock or investment product, and that whatever I say should also not be taken to be financial or investment advice. Yeah, and with the disclaimer out of the way, just a quick structure of today's presentation. So there are 5 sections in all. I have about 30 minutes, so I'll try to cover as much ground as I can. The first section is an introduction of myself. The second is to let you understand what the stock market really is. The third talks about the 6 key mindsets that I think investors need to have to be successful in the market. The fourth is where I'll be running through my framework for long-term investing in stocks. The fifth and last section deals with my thoughts on the current investing environment. As I think all of you may know, there's COVID-19 and large-scale government stimulus happening in the environment today, and stock markets and economies appear to have diverged. and what does this all mean for us as investors. So this is something that I'll be covering in the last section. And at the end of the after the presentation ends, there will be a Q&A session with Nigel as a moderator. So for today, I hope you guys will be paying attention to the second and third sections of the presentation. I think they are the most important parts because they are the foundation for our investing success. You know, you can be the best financial analyst in the world, but without the correct mindset or the right understanding of what the stock market is, it's very hard to be a successful investor, in my opinion. Investing is simple, but not easy. It's simple because, you know, we don't need fancy math or complex knowledge to invest well, but it's definitely not rocket science. But it's also not easy because we need to have a good control over our emotions when we're investing. And so I think the second and third sections hopefully can help you better deal with your emotions. So just quickly introduce myself. I think I'd like to again thank Nigel for a very beautiful introduction of myself. I think he has made me sound much better than I really am. Very quickly, I was with the Motley Fool Singapore from January 2013 to October 2019, so nearly 7 years. The Motley Fool is an online investment advisory portal. And my job at the company was to basically conduct research on the stock market and individual stocks and communicate the research to readers of our website. So I was a co-leader of the investment team at the Motley Fool Singapore, and we recommended stocks for subscribers to the company's online investment newsletters. So one of my proudest achievements with the company was to help its flagship investment newsletter, Stock Advisor Gold, beat the market. We launched Stock Advisor Gold in May 2016, and we recommended 2 stocks per month, one from the Singapore market and one from the international markets, which includes the US, UK, Malaysia, and Hong Kong. We measure the return of the recommendations by taking an average of the performance of the stock that we recommend. And at the same time, we also track the performance of a global stock market index. And as you can see in the table, the newsletter nearly doubled the stock market's return over a 3.5-year period. Today, besides running Compounder Fund, which Nigel briefly mentioned, I also run an investing blog together with my longtime friend, Jeremy. So The Good Investors is our personal investing blog, and it's where we share our thoughts, investing thoughts freely. And then, of course, there's Compounder Fund, which I also set up together with Jeremy. We launched it in middle of May this year, and we started investing activities for the fund in middle of July. As Nigel mentioned, the mission of the fund is to grow your wealth and enrich society. And Jeremy and myself, you know, we see it as more than just a business. It's a platform for us to do good. I don't want to spend too much time on this section talking about the fund. Maybe during the Q&A, if we want to, we can spend a little bit of time talking about it. But I want to make sure that I have enough time to deliver the content that I want to during this particular presentation. So section 2, what is the stock market, right? So the first stock market in the world actually was created in Amsterdam in the 1600s. And I think that many things have changed about the stock market, especially with the birth of the internet about 20 years ago. But I think there's one thing that has remained constant, and that is that the stock market is still a place to buy and sell pieces of the business. And I think having this understanding of the stock market will then lead to the next logical thought, and that is a stock will typically do well over time if its underlying business does well too. Now, this understanding makes the stock market become something simple to understand, but it also means that we have to be investing for the long run with an investing time horizon measured in years in order for us to take advantage of this simple relationship. Over the short run, the stock market is governed by the collective emotions of literally millions or even of investors. And these collective emotions are something that is incredibly hard to predict. So Warren Buffett's investment conglomerate, Berkshire Hathaway, is a great example of a stock that has done well because its underlying business has done well too. So for 53 years, from 1965 to 2018, Berkshire Hathaway's book value per share, which is its assets minus its liabilities, grew by 18.7% per year. Over the exact same time frame, its share price actually increased by 20.5% per year. Now, the 53 years from 1965 to 2018 included the Vietnam War in the 1960s and 70s, the Black Monday stock market crash in 1987, the breaking of the Bank of England in 1992, the Asian financial crisis in 1997, the bursting of the dot-com bubble in 2000, the Great Financial Crisis in 2008, Brexit in 2016, and of course, more recently, the US-China trade war in 2018, among many other major world events. But, you know, we can see that an 18.7% input has still led to a 20.5% output. So now we're on to the third section of the presentation, which is about the important mindsets. And to kick it off, I want to play a very quick game with all of you. I will introduce two companies, and both are real companies, and I want to ask all of you to just think about which of the two you would like to own, right? So the first company, it has been a nightmare for investors. From 1995 to 2005, it has fallen by 50% or more on 4 separate occasions. It has also declined by more than 66% twice. The chart you see, which is from a Motley Fool article by Morgan Housel, shows when and by how much the company's share price was below its high from the previous 2 years, right? And as you can see, company one has been an absolute nightmare. If you look at, say, around 1996, it was down by 80% from its peak 2 years ago, right? The next company has been a dream for investors. So from 1995 to 2015, over the same period, its share price actually increased by 105,000%. So if you invested $1,000 in this company in 1995, it would have become more than $1 million by 2015. So my question to you is, which would you pick, right? So very quickly again, company one is the one that had a very big decline, and company two is the one with a very huge gain. So just give you 2 or 3 seconds to quickly think about this. Okay, now I want to reveal the company. And actually, both the companies are the same. The company is called Monster Beverage, which is a US listed company that sells energy drinks. And I think the experience of Monster Beverage shows that even the best long-term winners in the stock market have also suffered from sharp short-term declines. So this is a very important mindset that we should have in investing. Know that volatility in stocks is a feature, not a bug. When stocks go through the ups and downs, it's not a sign that something is broken. Right, now to the second mindset. We cannot run from the fact that we humans are emotional creatures. When stocks fall, even with the knowledge that volatility is merely a feature of the financial markets, it's painful, it hurts. And when it hurts, that's when we can make stupid mistakes. Right, so I want to show you here, from November 1999 to November 2009, there was this US-based investment fund called CGM Focus Fund. It gained 18.2% annually. Now again, I just want all of you to make a very quick guess as to what return the fund's investors earned over the same period of time. Okay, about 1 or 2 seconds. Okay, now I'm going to reveal the answer. And the fund's investors actually lost 11% per year over the exact same period of time that the fund made 18.2% per year. And how did this happen, you might ask, right? So what happened was the fund's investors basically piled into the fund when it was doing well, but they sold at the first sign of trouble. And this caused the fund's investors to essentially buy high and sell low. So I think there is a great way for us to frame how we think about volatility in the financial markets, and that so that we can minimize its damage. And that is to think about volatility as a fee and not a fine, right? So fines are a punishment for doing something wrong. That we pay traffic fines, we pay legal fines. When we litter and we get caught in Singapore, we pay fines as well. But the thing is, when stocks decline, it's easy for us to think that we're being punished. But on the other hand, when we pay a fee, it's what we pay to get something worthwhile in return. We pay fees for doctors to get ourselves treated. We pay a fee for a concert ticket. These are things that we pay to gain something worthwhile in return. So many investors think of short-term volatility in the stock market as a fine. They think that it's because they've done something wrong. But we should really be thinking of volatility as a fee for something worthwhile, and that is great long-term returns. So I think this is the second important mindset that we should have. Right, now for the third mindset, what goes up must come down is one of the very common things about the stock market that I hear investors say. But I think if you look at the historical evidence, it actually shows otherwise. So this chart from Credit Suisse shows the returns of stocks from developed economies as well as developing economies from 1990 to 2013. This is data that goes back for more than 110 years. So in this time frame, stocks in developed economies, which is the blue line, have produced an annual return of 8.3%, while stocks in developing economies, the red line, have generated a return of 7.4% per year. Now, there are clearly bumps along the way, but the real long-run trend is crystal clear. For perspective, an annual return of 8.3% for 113 years turns $1,000 into nearly $8.2 million. So I think the third mindset we must have is that what goes up does not necessarily have to come down permanently when it comes to the stock market. But there's an important caveat for us to note here, and that is that diversification is crucial. And this brings me to the fourth mindset. Right, so single stocks or stocks from a single country can often face catastrophic or near permanent losses for various reasons. There's devastation from war or natural disasters. Companies or countries can be run by corrupt or useless leaders. And sometimes individual stocks or even stocks of an entire country can experience incredible overvaluation at the starting point. So these are just some of the factors that can cause single stocks or stocks from a single country to do poorly even after decades. And by diversifying, we can lower our risk. So, we can study a company or country's traits to understand things like valuations and the quality of leaders, but there's pretty much nothing we can do when it comes to catastrophes caused by mankind or Mother Nature. And so this is why diversification is crucial, and it's why I think investors, especially for us in Singapore, to look beyond our shores, given the small size of our economy and the relatively small number of companies that we can invest in our local shores. So the fifth mindset that we should have, so a common thing I hear from investors is that there's so much uncertainty now, and I prefer to wait for the dust to settle before I invest. And today, with COVID-19 as a backdrop, I think this sentiment is likely to be even stronger than before. But I want you to do something for me. Let's imagine that sometime in the future, there's one single year in which the price of oil will spike, the US will go to war in the Middle East, and the US will experience a recession. So how do you think the US stock market will fare over the next 5 years or over the next 30 years after this particular horrendous year? So just take a second to think about your answer and remember it. So all the three events that I mentioned, they actually all happened in 1990, right? So the price of oil spiked in August of 1990, the same month that the US went to an actual war in the Middle East. And then in July 1990, the US actually entered a recession. But here's the thing. From the start of 1990 to 1995, the S&P 500 was up by nearly 80%, including dividends and after inflation, right? And from the start of 1990 to 2019, US stocks were up by nearly 800% in total. And I think what's really fascinating here is that the world has actually seen multiple crises in every single year from 1990 to today, as shown in the table, right? We can see that in, say, 1998, there was the Russian debt default and there was the collapse of long-term capital management. In 2003, there was the Iraq War, there was SARS. In 2013, there was the Cyprus bank bailouts, which was actually a pretty big thing back then. But today, nobody remembers it. And I could remember it clearly because it was the year in which I started my career with the Motley Fool Singapore. And back then, a lot of people were talking about the Cyprus bank bailouts, right? So the fifth mindset that we should have is that there's always uncertainty, but we should still be investing, right? And now to move on to the sixth mindset, and it is about having expectations, but not predictions when we're investing. The two concepts may seem similar, but I think they are very different. So an expectation, right, is developed by applying past events when thinking about the future. So for example, if I say that the US economy has been in recession multiple times throughout modern history, so it would be reasonable to expect another downturn to occur over the next, say, 10 years. That is an expectation. A prediction, however, is saying that, I think a recession will happen in the third quarter of 2025. And this difference between expectations and predictions results in different investing behavior. If we merely expect bad things to happen from time to time, while knowing we have no predictive power, then we would be building our investment portfolios to be able to handle a wide range of outcomes. And in this way, our portfolios become very robust. But if you're trying to make predictions, then we think we know when something will happen and we try to act on it. And this causes, I think, our investment portfolios to become fragile because our portfolios will only be suited to thrive in a narrow range of situations. If the circumstances turn out differently, then our portfolios will be hurt badly. And then this causes our portfolios to become fragile. And I think it's important to realize that humanity's collective track record at predictions are horrible. And if you need any proof as to how bad we are at predictions, then just think about how many people actually saw the widespread impact of COVID-19 ahead of time, right? So the sixth mindset is that we should have expectations, but not predictions when we're investing. With that, I'd like to move on to my investment framework, how I think about how we should approach investing. So my framework consists of 6 criteria, and these criteria can all be found in my blog, The Good Investors, under the investment knowledge base section. And I believe that the framework will be able to lead us to companies that can grow at high rates over the long run. And the question is, why do I want companies that can grow at high rates over the long run? And this because, this comes from our understanding of the stock market that I mentioned earlier, that a stock will do well over time if its business does well. And in fact, I think that the 6 criteria are traits that I want a company to have if I was able to design from scratch the ideal long-term growth company. And before I start going into the framework, I just want to stress that my investment framework is not the only way to invest. I don't think it's also the best way to invest, but I see it as having a strong logical foundation, and it's something that has worked very well for me over time. So for example, during my career with the Motley Fool Singapore, I actually used this framework to help me search for investment opportunities. Right, so for the very first criteria, I want companies with revenues that are small in relation to a large and or growing market, or revenues that are large in a fast growing market. Now this criteria is important because I want companies that have the capacity to grow. A company will be facing an uphill battle to achieve growth if it is stuck in a market that is shrinking. And I think it's important to note that I'm looking out for trends that are powered by long-term secular tailwinds. I want trends that have a lot of room to run. I do not want just fads. Yeah. And my second criteria is that I want companies with strong balance sheets that have minimal or reasonable levels of debt. So there's this term called anti-fragility that is introduced by Nassim Taleb. He's a former options trader and the author of numerous books, including Black Swan and Anti-Fragile. So Nassim Taleb classifies things into 3 groups. There's the fragile, which breaks when exposed to stress, like a piece of glass. When we drop glass, they shatter. Then the second group is the robust, which remain unchanged when stressed. So for example, we have a football. When we kick the football or when we drop the football from a reasonable height, it's not affected. And then the last group will be the anti-fragile, which are organisms or systems that strengthen when exposed to stress. So our human body is actually, I think, a great example of an anti-fragile system. When we exercise, which is some stress, we become stronger. So I think that companies can also be fragile, robust, or anti-fragile. And the easiest way for a company to be fragile is to have a lot of debt. So if a company has a high level of debt, it can crumble when facing even a small level of economic stress. Now, on the other hand, if a company has a strong balance sheet that has minimal or reasonable levels of debt, then it can be robust or even anti-fragile. So during tough times, for whatever reason, if a company has a strong balance sheet, it has a high chance of surviving. But not only that, having a strong balance sheet can even allow a company to go on the offensive, such as by hiring talent and winning customers away from weaker competitors. Or the company can even have a head start in developing new products and services while its weaker competitors have to reduce spending. So in such scenarios, companies with strong balance sheets have a higher chance of emerging from a crisis, which is a period of stress, stronger than before. So my third criteria, I want management teams with integrity, capability, and an innovative mindset. So a management team without integrity can fatten themselves at the expense of shareholders, and that's not something that we want. Meanwhile, if the management team is not capable, then the company will be finding it very difficult to grow. And of course, without innovative mindset, it's very easy for a company to be overtaken by competitors or run out for the room to grow. And on the issue of integrity, I like to study how management's pay has changed over time in relation to the company's business. So I look at things like how has the pay of management increased while the business is declining. So these are situations that I tend to avoid. I also look at how management is compensated. I want the management team to be paid according to metrics that make sense to me as a company shareholder. So I like seeing metrics such as growth in free cash flow per share, growth in book value per share, or multi-year changes in the company's stock price. And on the issue of capability and innovation, what I do is I study a company's past actions to grow its business. Unfortunately, I think this is an area where subjective judgment is required. that it's not a case of like, if a company if a company meets certain criteria, then it has innovation or the ability to execute well. So I think a lot of this has to do with judgment. I study a company's history and I think about what the company has done over time to grow its business. Now, so I think a great example of a company that is capable and can innovate is the US listed company Mercado Libre. So the company is currently the largest e-commerce organization in Latin America. It started life in the late 1990s, operating online marketplaces in Latin America. So think of it as, a marketplace is just simply a platform that connects buyers and sellers of goods. And but the thing is, because payments infrastructure is very poor in Latin America, so like unlike in Singapore where credit cards are very common, in Latin America it's not the case. So what Mercado Libre did was they started an online payment service called Mercado Pago in the early 2000s to facilitate online payments. And over time, Mercado Libre started expanding into both offline payments and outside of Mercado Libre's marketplaces as well. And the other thing that management has done over time is to actually build out shipping solutions. So in 2013, Mercado Libre launched Mercado Envios, which is its shipping solution for Latin America. Again, this is because shipping has a very poor infrastructure in Latin America, and it's not easy for goods to be delivered to customers. So Mercado Libre saw the opportunity and created a shipping solution. And so today, both Mercado Libre and Mercado Pago have actually grown significantly over time. So this criteria number 3 is actually one where I spend a lot of my time on. And that is because I think that management is the ultimate source of a company's economic moat or competitive advantage. So the term economic moat was coined by Warren Buffett. When a company is very profitable, finance theory states that competitors will emerge to basically compete those profits away. But the thing is, there are some companies that are able to remain very profitable for a very long period of time because they have some form of economic moat. So there's a lot of work that has been done by investors on understanding economic moats. And these moats have traditionally been thought to appear in the form of 5 ways. So the first is there are high switching costs for customers. The second is when the company is a low-cost producer in its market. Third is when the company has a network effect, where the addition of a user to the network makes the network even more valuable for existing users. The fourth is when a company holds intangible assets that are very difficult to replicate, such as patents and intellectual know-how. The fifth thing is when a company has efficient scale in production. So these are the traditional ways that people understand economic moats to appear. And I agree with all of them, but I think that management is actually the ultimate source of a company's competitive advantage. And that is because a company's current economic moat is the result of management's past actions, while a company's future economic moat is the result of management's current actions. Right, and so now we move on to the 4th criteria, and it is revenue streams that are recurring in nature, either through contracts or customer behavior. So I think this is something that a lot of investors do not pay attention to, but I think that is very important. So I think that recurring revenues are a crucial trait because it means that a company need not spend resources to make a past sale. Instead, the past sales are recurring in nature, and the company is actually free to find brand new avenues for growth, right? And recurring revenue can come from contracts, can actually come in the form of subscriptions, such as Netflix, which I think a lot of us are likely to be familiar with. And then for customer behavior, I think we can look at the case of, like, say, Starbucks, MasterCard, or Visa as great examples. We frequently buy drinks from Starbucks and we make payments with our credit cards that come from MasterCard or Visa. So these are the types of recurring revenues that I like to see in the business. And the 5th criteria, which is a proven ability to grow. So I think that a company's past track record of growth in the business is actually one of the best indicators for its future growth, because I think that winning businesses tend to have an inherent momentum. So let's think about this. Let's walk through this, right? So if a company is doing well, it has more resources, it has more revenues, it has more cash flows. It can reward its employees better, and this gives it the resources to be able to employ better employees. At the same time, if you are an ambitious, highly talented employee, you can look at a a company that's doing well, and you'll be more tempted to join it as opposed to a company in the same industry, but that is not doing as well. So I think that really good businesses tend to have a winning momentum behind them. And so what I like to look out for is I want a proven track record of growth. So I like to look out for companies that have big increases in revenue, net profits, and free cash flow over time. So sometimes just revenue and free cash flow growth is good enough, but I am generally wary of companies that produce revenue and profit growth without any increases in free cash flow. Sometimes companies can also produce very strong revenue growth, but they also suffer losses and or negative free cash flow. So these are situations that I tend to avoid because cash is the lifeblood of a business, and a company that is showing a lot of profit can still run into severe financial stress if it is unable to produce much free cash flow. So, but all this said, right, I'm still happy to make exceptions for companies that are currently generating losses and burning cash if they are in pursuit of growth. And if I can also see that they have a clear path to profitability and strong cash flow production in the years ahead. So my last criteria is that I want companies with business models that give me confidence that they can generate a strong and growing stream of free cash flow in the future. So a company's ultimate economic value is simply the sum of all the cash that it can generate from now to forever, discounted back to the present. So the more free cash flow that a company can produce, the more valuable it is. And so when I'm looking at a company to invest, I'm always thinking about how much cash can this company generate from its business years into the future. Right, and so just very quickly, a recap of all six of my the six criteria that I have for my investment framework. So first, we have a large and a growing market. Second thing, we have a strong balance sheet. Third thing, we have innovative management with integrity and capability. Fourth thing, we have high levels of recurring revenues. Fifth thing, we have a proven track record of growth. And the sixth criteria, a company that can generate a strong and growing stream of free cash flow over time. But there's a note of caution here, and that is that even the companies that excel according to my investment criteria may still turn out to be very poor investments, and it's impossible to get it right all the time in investing. Throughout my career in investing, I started investing more than 10 years ago, or nearly 10 years ago in October 2010. I have experienced many big losers, but fortunately, the overall results have still been good. And that is because I have been investing in a very diversified manner. So for me personally, I think that it's important I diversify with about 30 to 50 companies in my portfolio, with companies from different industries and countries. I believe that every investor should invest in a way that gives them the most comfort. So everybody will have a different level of what is the right amount of diversification. And just to give you some context and perspective, right? There are three investors that I really admire. And all of them have very different levels of diversification. So the first is Peter Lynch. So Peter Lynch actually held up to 1,400 stocks in his portfolio by the time he retired in 1990. So he was investing from 1977 to 1990, and he did phenomenally well with a 29% annualized return. And Peter Lynch actually held 1,400 stocks in his portfolio when he retired. The second investor is Walter Schloss, who I think was an active investor from the 1950s to 2000. And he generated about 16% per year over that 40 to 50 year time frame. And at any point in time, Walter Schloss typically held 50 to 100 stocks, right? So this is more stocks than I typically feel comfortable with, but it has worked very well for Walter Schloss. And then lastly, there's Warren Buffett, who is well known for running very concentrated portfolios with his own hedge fund in the 1950s and 1960s. And he generated a tremendous return, I think more than around 30% per year for when he was actively managing his hedge fund for about between 13 to 15 years, if I remember correctly. But during this period of time, Buffett only was running a very concentrated portfolio with only a handful of stocks, right? So I think some of you may also wonder how my investment portfolio can protect my portfolio. So I just want to be very clear and say that the framework cannot protect my portfolio from short-term declines in stock prices. This is not something that I want to protect myself against. If a recession or bear market happens, my portfolio will get hit in terms of the stock price. But how my investment portfolio can protect me is by leading me to companies with the following traits. strong free cash flow, robust balance sheet, high levels of recurring revenues, and a great management team. So I think that companies with these traits, right, are very well equipped to survive or even thrive during downturns. And I think that this helps to protect the true economic value of my portfolio over the long run. Right, and with that, we reached the last section of my presentation, which is my thoughts on the current investing environment. So there are three things that I want to talk about here. So the first is that I think I want to first discuss what COVID-19 has not changed. So I think that what the pandemic does not change is the fundamental identity of the stock market, which is a place to buy and sell pieces of a business. And if the pandemic does not change the fundamental identity of a stock market, then this also means that the long-run relationship between stock prices and business fundamentals are the same. And so because of this, right, I'm just going to be sticking with my investment framework of looking for companies that have high chance of growing their businesses significantly in the years ahead. So COVID-19, again, does not change the fundamental nature of the stock market. And I think that with that, if you have a philosophy for approaching the stock market previously that was already working, then I think that it can still continue working over time, even with the pandemic as a backdrop. So the second thing I want to talk about is the current divergence between the stock market and the economy. And I think that this is something that a lot of us have been thinking about, right? So the thing is, I want to say that our current experience is actually not the first time that stocks and the real economy have taken different paths. So we can actually look at the panic of 1907 as an example. So the panic of 1907 was a period of severe economic contraction in the US, and it is not widely remembered today, but it had a huge impact back then and was in fact one of the key motivations behind the US government's decision to set up the Federal Reserve in 1913. The Federal Reserve, as some of you may know, is actually the US central bank. And for perspective of how tough the panic of 1907 was, so when 1908 started, business volumes in many industries actually fell by 72% from a year ago. And by the middle of 1908, business volumes had recovered to just 50% of what they were in 1907. Right, so it was a very horrendous time for the US economy. So let's take a look at how the US stock market actually did from 1907 to 1917, so a period of 10 years. Right, so what we can see is US stocks actually fell for most of 1907. They bottomed in November of the year after declining by about 32% from January. But then they started climbing rapidly in December and then throughout the rest of 1908. And the US stock market never looked back for the next 9 years. Right. I think it's interesting to see because, I discussed earlier that 1908 was a horrible year as well for the US economy. The business volumes were significantly lower than in 1907, but yet the stock market was climbing and continued climbing for the next 9 years. Right. So what I'm sharing here is that I'm not trying to say that I know what's going to happen next for the stock market. I really have no idea, but I'm just trying to provide context, about what we are currently experiencing today. The market can be short-sighted at times, but it can also occasionally look out pretty far ahead. And I think that, the market seemed to be looking out ahead in 1907 and 1908, and it may very well be doing the same thing today. And I also want to point out something, and that is that, in the second quarter of this year, US GDP actually fell by over 9% compared to a year ago. But some of the US stock market's largest companies actually experienced revenue growth. So for example, we have Amazon, which grew its revenue by an amazing 40%. Then we have Facebook, Apple, Microsoft, which all grew their revenue in the low teens range. So one thing I want to hammer home today is that the stock market and economy are not the same things. And this is something that I think all of us need to recognize. They are two completely separate things, right? And the third topic that I want to discuss about the current investment environment is my thoughts on the large-scale government stimulus programs and what they mean for investors today. So I honestly have no idea what the outcomes will be today. I think that these government stimulus programs and how they affect the economy are really complex topics, and it's not something I have a good handle on. So I think it's really important for us as investors to know what we don't know. So in my case, macroeconomics, so things like the government stimulus and their implications, they are not topics that I'm good at. I don't understand well. But I think it's crucially right that I do not think that this me not knowing the macroeconomic picture would make me helpless in investing in stocks. Because as I mentioned earlier, right, the most important relationship in the stock market is that a business will do well over time. A stock price will do well over time if the business does well. So I do not have any insight on the current macroeconomic forces at play, but I think I'm still able to develop good insight on the possible futures of individual companies. And as a stock market investor that's focusing on individual companies, I think just being able to understand select companies is actually good enough for me. And before I end and go on to the Q&A session, I just want to also share my overarching view of the stock market, which I think is very important also in today's climate. So I very proudly say that I'm a long-term optimist on the stock market. Today, there are 7.8 billion individuals in the world, living in the world, and the vast majority of all of us will actually wake up every morning wanting to improve the world and our own lot in life, right? And I think that this is ultimately what fuels the global economy and financial markets. Crazy people and Mother Nature will sometimes create huge problems for us, and we have seen that today COVID-19, which is a product of Mother Nature, has actually caused huge problems for us and resulted in massive economic intervention by governments. And these things, we don't really know what the economic consequences will be. But I still retain faith in the collective positivity of humanity. And I think that if there's any mess, then humanity can clean it up. If you look back at the very long run of human history, this is the story of humankind. We clean up our mess from time to time. And this is how progress actually looks like. And so I think that as long as I have faith in humanity, I will be long-term optimistic on stocks, because I think that investing in the stock market is ultimately the same as having faith in the long-term positivity of humanity. The stock market is a collection of businesses set up by entrepreneurs wanting to solve problems that they see in the world. And because of this, I'm very much a long-term optimist on stocks, unless they become very crazily overvalued. And with this, I come to the end of my presentation. And just for full disclosure purposes, the fund that I manage, Compounder Fund, owns shares in the companies that I mentioned earlier. Compounder Fund owns shares in Mercado Libre, Netflix, Starbucks, MasterCard, Visa, Amazon, Apple, Facebook, and Microsoft. And these are also some of my contact details. And with that, I thank all of you for your time, and I look forward to start answering some questions. So Nigel, handing it back to you.
Thanks so much, Ser Jing. I think your sharing was really, really insightful. One thing that I definitely learned was that nobody is perfect. I think I personally have been investing for many years. And one thing I learned from the best investors is that they actually acknowledge what they do not know. And they focus on the things they are good at when it comes to investing. So I think that's very good. I think to kick off the discussion, I will start with some questions of my own that I had while listening to your presentation. The first question is, you study engineering and you choose to leave engineering to jump into your passion in investing. So what gave you the confidence to take the leap, and what was going through your mind? I think this would be something that a few people in our audience are also thinking about nowadays.
Yeah, sure. Thanks for wanting to know more about my backstory. So the thing about me is that when I was choosing my course for university, I actually had a place as well in SMU, Singapore Management University, to take I think it was accountancy. So it was more like a business type of degree. And so I was deciding between engineering and a business degree. And the reason why I ended up with engineering is because I thought it would be a lot easier to learn about investing on my own. I also have a passion for mathematics and the sciences, so engineering was also a pretty good fit for me. And so I thought that it would be a lot more difficult to learn about engineering on my own. And so I thought, okay, let's just study engineering and then learn about investing on my own. So what I did in school was I was actually a pretty lazy student on paper, because I did not join any CCAs or anything like that. But what I did was during my free time, besides spending a lot of time playing computer games and football, I also spent a lot of my free time just reading about investing. So one of the things that I really loved doing was that I recall fondly was that I actually downloaded the client memos written by this investor named Howard Marks from Oaktree Capital. I downloaded all his memos written in chronological order and I read through them. So it's a collection of, I think it was hundreds of pages, thicker than a book. And I read through all of them in chronological order. And that's just an example of like the things that I was doing as a student in university, just trying to learn about investing on my own. So I think like over time, throughout my 4 years in uni, as I dug deeper into investing, that kind of gave me the confidence that I kind of knew what I was doing. And at the same time, I was also very lucky. I think that my career path has also been a series of very fortunate incidents. So as an example, I joined the Motley Fool, right? And they actually came into Singapore just shortly after I graduated. So I worked in an engineering firm, like you mentioned, for about 3 months after I graduated in 2012. And the Motley Fool came to Singapore in January 2013. So just a few months after I graduated. And so they called me up and asked me if I wanted to join. And I thought, this is a fantastic opportunity. I love the company. It had a fantastic mission. Today, the Motley Fool's mission is to make the world happier, smarter, and richer. And it's beautiful. And yeah, so I had a great time there. And so I think, just my time in uni learning about investing just gave me the that I can make this work. Yeah.
Very, very glad you found your calling. For those who don't know who's Howard Marks, right? He's actually one of the most famous distressed debt investors of our time. And he actually writes memos for free. So do support his memos. He has very, very deep insights that will prepare you as well for your investing. So I understand that a lot of people have been listening to a lot of noise in the market, what people think, is it bull and bear? How do you use your framework and your mindset to separate the emotions that we have while investing and psychology or logic?
Yeah, so I think one very important thing is what I did also was to just really understand and study market history. So studying market history enabled me to understand that volatility is part and parcel of the game, like I showed with Monster Beverage in my presentation. The other thing also is that it also enabled me to understand that humanity's progress has never been smooth, right? And the stock market has actually mirrored humanity's progress. So an example I really love is that, it took us only 66 years from the Wright brothers demonstrating the first manned flight at Kitty Hawk to putting a man on the moon. So between flying like this very rudimentary gliding plane to launching a rocket to the moon, right, it was only 66 years. But in between, right, that 66 years was also World War II, which killed, 30 to 40 or even 50 million people. So it was a horrendous tragedy. But this is, I think, like a really great example of how progress happens for society. And I think that just understanding this will also enable us to, I think, a better handle these ups and downs in the market with equanimity. So I think understanding history is a very important component of being able to manage emotions well. But this said, right, when I first started my career at the Motley Fool, I always thought that a good psychological control is actually something that can be taught. But over time, I'm starting to develop the idea that some people are perhaps just born with it. I have received many questions about, are there any systems that I put in place to be able to better manage my emotions? But the truth is that I don't. And I have never actually been worried or when stocks decline. I don't really know why this is the case for me, but I'm just starting also to think that perhaps there's also some genetic
maybe superpowers.
I don't know.
Yeah, that's really interesting to know that you have always had a calm and collected mindset no matter what happens.
I think that history is super important. Yeah, just understanding how stock markets have developed over time. I think that I think will be very helpful even for people who are perhaps more biologically inclined towards panic when stocks decline.
So what is your preferred holding period as an investor?
Yeah, my preferred holding period is as long as a company remains a fantastic business. And I think the interesting thing is that a company can remain a fantastic business for much longer than we imagine it to be. So for example, right, Amazon was founded in 1994, was listed in 1997. At nearly any point in time from 1997 to today, if you had invested in Amazon, you would have made significant amounts of money, even if you had invested in Amazon at the peak of the dot-com bubble. So for context, Amazon IPO'd at maybe about $1.50 per share by the peak of the dot-com bubble in the early 2000s or late 1999. The share price was nearly $100. It then fell all the way to about $7 at the bottom of the dot-com bubble. Today it's at $3,000 plus dollars. So even if somebody had bought Amazon at the peak of the dot-com bubble at $100 per share, they would still have made 30 times their money. And the reason is because Amazon, even today, is still growing its revenue at tremendous rates. So it's still a phenomenal business, and it has been a phenomenal business for more than 20 years already. So I think this is a great example of, like, you know, how a company can still remain a really, really good business for a very long period of time. So my favorite holding period is as long as a company remains as long as a company still has a fantastic business.
Yeah, that's a very good point. I think some companies actually last more than an average person's lifetime. So that's a very good way to look at it. Okay, before we go to the questions, there's actually more than 20 questions asked by the audience. So I'm excited to sort of charge those questions at you. But before that, we have a short final poll to learn more about what people are interested to invest in. Yeah, on the topic of this poll, right, it's about alternative investments. Some of them deal with non-equity investments. So what do you think about trying out other asset classes as a way of diversifying?
Oh, I can't vote, but if I could, I would pick startups and unicorns. And perhaps fintech lending as well. I think I'm really attracted to fintech as a space because I think it's wonderful that a lot of companies are trying to democratize access to people to access the financial system. I think for us living in Singapore as a developed economy, we have no idea how many people are still unbanked or underbanked. And I think that fintech is a great way for inclusion, to bring as many people as possible into the financial system and create growth for their communities. Yeah.
That's very good. I think that being Singaporean, being developed, the onus is on us actually to bring great financial technologies to the regions that are underbanked. Okay, now I will jump into the important segment where we answer questions from the audience. I think because we have so many questions, let's try to keep the answers short and sharp when we answer, and we try to answer as many questions as we can. So the first question is, with COVID coming closer and with us getting seemingly closer to finally finding a vaccine, COVID kind of growth stocks going to advance, or are they likely to suffer a drop due to sector rotation and profit taking?
Yeah, so these are topics that I really don't think about. I don't think about sector rotation. I do not think about short-term declines. What I'm really concerned about is the long-term trajectory of businesses. So I think if you look at COVID-19, a lot of the companies that are doing very well today. For example, if you look at, say, Zoom, which Compounder Fund also owns, Zoom in the second quarter of this year grew revenues by more than 350%. Incredible performance, and it's generated significant amounts of free cash flow. Part of it was because of a push of adoption because of COVID-19. But before COVID-19 happened, Zoom was already growing at a very, very rapid pace, right? And so I think it was already riding on a very powerful tailwind even before COVID-19 happened. And I think that for a lot of these businesses that did well because of COVID, they still have powerful long-term trends that are backing them, or they are still in the process of creating these powerful long-term trends and expanding their market opportunities. So I'm very much, when I think about investing, I'm always thinking about what will this business look like over the next 5, 7, 10 years. So yeah, things like sector rotation and short-term prices, I think it very well can happen. In fact, I wouldn't be surprised if they happened, but it's really not something I concern myself too much over. Yeah.
Cool. I think this question is applicable to many people listening today. How do you recommend new investors to start on their investing journey?
I think gaining knowledge is really important. We can start with books. So so some of my
Any to
favorite.
recommend?
Yeah. My one of my favorites is actually I think a book that a lot of people may already know, but I was recommending anyway, which is One Up on Wall Street by Peter Lynch. I think it's a fantastic a book for beginners to learn about investing, but it's also great because even for professionals who read Peter Lynch book, they would still have so much to learn from it. So I think it's a really great book for beginners, novices, as well as professionals to learn from. So I think that's fantastic. And I think there's also there are a lot of investment courses in Singapore that I think are doing and newsletter providers that are doing great work. So for example, I have friends. I have friends in like the Smart Investor, which is this online investment advisory portal. I think they create really good content to educate investors. Also have friends in this organization called The Fifth Person, which also runs investing courses, and also Value Invest Asia. So I think they're all doing really good work, producing valuable educational content for investors. And I think a lot of them are geared towards trying to improve the knowledge base of new investors. So I think that you can start with books, or you can start with these websites that also sell newsletters or investment courses. Yeah. So I think can be great sources to develop knowledge about.
I think the knowledge is out there. You just got to go and find it, and there's no secret recipe. There's no big secret about how to invest. If you find the right people, you get the right books, you will have a good first start.
Yeah. And I also fully expect the ADDit Academy to one day be also somewhere along the same platform as like Fifth Person, Smart Investor, Value Investor, and so on. Yeah.
We'll do our best. The next question is how do you determine whether a management team is solid or not?
Yeah, so I think this has to, again, there's a lot of subjective judgment into it. I think investing is a really interesting problem because, so I classify, so to me, the world has two types of problems. There are puzzles and there are mysteries. So puzzles are problems that can be solved with more information. So for example, like if somebody were to ask you, where is, say, Osama bin Laden? If you have the information, you can find Osama bin Laden. But then if somebody asks what's going to happen to the Taliban after Osama bin Laden dies, then I think that is a mystery, because you can have so many different opinions and no one really knows what's going to happen. So in mysteries, right, having more information will not be able to help you. What you really need is critical thinking and the ability to make informed judgments. So I think investing is very much a mystery in that sense, where having more information need not necessarily result in a better result. And so because of this, I think that when we assess management teams, there's a certain subjectivity involved. So what I think is a good management team may not be what some other some better investors think is a good management team. So in my case, what I try to look out for management teams that think about the world differently. So I mentioned Netflix earlier. So I think Netflix is quite fascinating about how it thinks about the world. So if Nigel, if I ask you like, what is Netflix competitor, how would you respond?
I would think it's Amazon Prime.
Amazon Prime. Some people say Disney Plus, maybe Apple TV, right? HBO. Yes. These are, but to the CEO of Netflix, Reed Hastings, competition to him is sleep, exercise, music concerts, dinner with family, books, anything that you spend your leisure time on. Not watching Netflix is competition. Wow. So that is a very unique way of looking at the world. And I try to look out for these very idiosyncratic ways of understanding the world. Another example, which is an example that I really love, is Costco. So it's a company that Compounder Fund owns as well. Costco does warehouse retail. So they operate huge warehouses and they sell merchandise in there. But one very fascinating aspect of Costco is that it only ever marks up its products, right, between 11 to 14% of cost. Meaning that let's say if it purchases a product for $10 from a supplier, it's only going to sell it for maybe $11 and some cents. And the fascinating thing is that when there have been documented cases where, say, Costco initially purchased a product for $10 and was selling it, say, $11.50, for example, when the cost price of this product was brought down to $5, Costco actually lowered the selling price of the product to keep the same margin. So from $5, the selling price may become, say, $5.80 or something like that, instead of keeping it at the previous selling price of $11.50. And the reason is because Costco has a firm belief that it always wants to give the lowest prices possible to consumers. And I think that this is actually very difficult to do. It is, in fact, I think, an unreplicable competitive advantage because it goes directly against the very human nature of greed. All of us are greedy. Like if I were to run a business, I don't think I might have the same type of mental strength to be able to do something like this. But Costco has done it ever since its founding in, I think, the 1970s or 1980s, all the way to today. Yeah, and I think, so this is, I think, a very unique way of also looking at the world. So I'm trying to find management teams that have this unique lens of looking at the world. Yeah, so I think this is like a succinct way of describing what I want out of management teams. Yeah.
Oh, that's a very, very good, very insightful thing. I've never heard about that. There's a question from Sherry, right? Asking about diversification. Is there a recommended number of stocks that someone should have?
Yeah, so I think like during the presentation, I also mentioned these three investors, Peter Lynch, Walter Schloss, and Warren Buffett. They each have very different levels of diversification. But I would say that depending on the investor's skill level, I think the more, for somebody who's just starting out, I think it's better to be widely diversified. And so in this sense, I think the robo-advisors in Singapore are a tremendous innovation for I think the investing public in Singapore, because they allow investors to very cheaply and very conveniently build very diversified portfolios. And I think that it's especially for investors who are just starting out, I think it's a great avenue to just, build a very diversified portfolio from day one. Through robo-advisors, you can get globally diversified portfolios, and by diversified, I'm talking about like owning thousands of stocks. And I think that's a very safe way for investors to get their feet wet in the market. But I think overall there really isn't a right answer. There are great investors that own, say, maybe 5 stocks at any point in time only. And then at the other extreme, there's like Peter Lynch, which owns like 1,400 stocks, right? So I think that there really isn't a right answer. It's more of like understanding your own temperament, your own psyche. I know that if I were to be investing with, say, 10 stocks in compounder funds portfolio, I wouldn't be able to sleep at night. It would stress me out very badly. So, and I think that 30 to 50 is something that works very well for me, because it's something that I have been doing for my own family's portfolio when I was managing it before I started compounder fund. Yeah, so I'm just taking that same number of stocks that I was managing for my family into compounder fund. Yeah, so unfortunately, I don't have like a definite answer.
Do you think that we should stay fully invested all the time, regardless of situations?
I think again, okay, so statistics have shown that if you were to miss just a handful of the stock market's best days, then your return would fall dramatically. So okay, these numbers I'm making up because I cannot remember the exact ones, but they are roughly in the same ballpark, right? So for example, let's say from the 1970s to today, if you invested in the S&P 500, you may have made, I don't know, 8 or 9% annualized. But if you miss, say, maybe the top 25 or top 50 best days in the market, your return will actually fall to maybe 1 or 2% or even lower, right? And so what this means is that if you are unable to time the market, meaning that if you are unable to foresee when the market will decline and when the market would rebound from the bottom, then I think the best strategy would be to be nearly fully invested at all times. And so this is what we are doing as well for compounder fund, and what I've been doing as well for many years in my own personal investing activities. But that said, I think it's also important to consider the psychological aspect. So for some people, having a cash cushion helps them sleep well at night. And I think that the most important thing for investors to have is to be able to sleep well at night when they invest. If you cannot pass the sleep at night test, then I think that you're investing wrongly, and that you should take changes to your process to make sure that you can sleep well at night while knowing that you are still invested. So I think that there's no hard rule as to how much cash an investor should have in the portfolio at any point in time. It all depends on, I think, the investor's temperament and also I think the skill in terms of being able to pick market tops and bottoms. I think some people are very good at that, but as I mentioned earlier, as investors, we should know what we are not good at. And so I'm not good at picking market tops and bottoms. I have zero insight on such matters. So I choose to be nearly fully invested at all times, while also knowing that my psychological makeup enables me to invest in a stress-free manner while being fully invested.
This question is from Anonymous. Is there a point where you feel like something is too expensive? I think the context is there's this saying, people in the news have been saying that growth stocks, like the big FANG man, have been like super overvalued currently. What is your thought about that, and what will happen next?
Well, so what I will say is that I absolutely agree that there is a price that where a stock becomes a lousy purchase, a lousy investment, regardless of how good the underlying business is. But at the same time, I also think that the gap between what is a good price versus what is a lousy price is a lot wider than people think. So I actually did some research before. Back when I was at the Motley Fool Singapore, I looked at this company called Walmart, which is like a competitor to Costco in a way. So Walmart is like the NTUC, Sheng Siong, and what's the other one? Sheng Siong, NTUC,
Cold Storage?
Dairy Farm. Sorry,
Oh,
Cold Storage.
Cold Storage, yeah.
So it's Walmart is that kind of business, yeah. But in the US, and what I've realized is that so I did that research in I think 2014 or 2015. So if you go back to the 1970s when Walmart was listed, I looked at how much what is the price earnings ratio that an investor could pay for Walmart shares in the 1970s and yet still make like a 15% annualized return from the 1970s, to 2015 or 2014. And the answer I found surprised me, and that was, I think, was either 200 or 300, maybe even 500 times trailing earnings. So we're talking about a P ratio of like between 200 to 500. I cannot remember the exact figure, but it was an astronomical number that surprised me. And so I think what this shows is that when a company has a significant runway for growth, and also a very high probability of being able to grow into the market, then I think that what looks expensive today can still end up being cheap over the long run. Yeah, but that said, again, I don't think there is a silver bullet or like a magic formula that you can use to determine, okay, this stock is expensive, this stock is too overvalued, and stock A is too overvalued, and stock B is not overvalued. I don't think there's a good number. You cannot say like anything above say a P ratio of 30 is expensive. I don't think this. I don't think valuation ratios can be used this way. It's really a matter of context, and the context is what is the growth opportunity of the company in relation to the state of the current business today, and at the same time also the probability that it can continue growing this market. And I think one thing people don't realize, or rather a lot of investors don't realize, is that the market as a whole prizes or highly values companies that do very well according to these two traits. So if you have a large market opportunity and also a very high probability that it can grow reliably over the long run, the shares tend to carry what looks to be high valuations for a very long period of time. So yeah, this is a good perspective. Long rambling answer. My very long rambling non-answer to the question.
There's this question coming from somebody in the audience.
Sure.
They understand that the fund does not allow retail investors in. So what's the plan maybe in the future for Compounder Fund?
So yeah, this is a good opportunity for me to just talk about one of the key pillars for Compounder Fund. So Compounder Fund can only serve accredited investors today. But for Jeremy and myself, our long-term goal is to open a fund up to retail investors. And it's not easy because running a fund for retail investors is actually a lot more expensive as compared to running a fund for accredited investors. At the same time, there's also a lot more operational complexities involved. And but the thing is, Jeremy and myself, we think that it is the right thing to do because we believe that good investment solutions should not be only for the wealthy public in Singapore. It should be for everybody, both the wealthy and the people with lesser means. I think that's what good investment solutions should be. The thing is, I think for us to get there will be a multi-year process. We will need to grow the assets of the fund to a very large degree. And at the same time also, put in place all the proper operational requirements, like for example, having our own in-house compliance teams, our own in-house risk management teams, and so on. Before I think we have before we can go up to the regulators and say that, hey, we would like to open this fund up to retail investors. Can we do so? Yeah. So I think it's going to be a multi-year journey. In fact, there's also a lot that Jerry and myself do not understand or know about running a fund for retail investors, and we want to learn. So if any of you here know of people that I can talk to, please reach out to me.
Yes, I think that's a very amazing long-term goal you have. And to those retail investors listening today, we just got to be patient. One day we'll have an opportunity, hopefully.
Hopefully sooner rather than later.
Yeah. We have time for two last questions. One question is about which sector, be it healthcare, finance, technology, industrials, materials, consumer staples, consumer discretionary, should always be inside all-weather kind of portfolio.
All-weather, wow, that's interesting. Okay, so I cannot really speak for like an all-weather portfolio. I think the person who asked the question might be referring to like a Ray Dalio type of all-weather portfolio. I don't know the specific. Yeah, I don't really know the specifics of that portfolio. But what I would say is that personally, I'm looking out for in the company characteristics more so than industry exposure. So in my case, for the fund, when we built the fund, we made it very clear that there will be no limits on the concentration to any particular sector. And the reason is because we want to have the freedom to be able to move into any companies that we find attractive. And if it happens that all these companies belong to one particular sector, and so be it, what we're really looking out for are traits that we want to see in our investments. And so I think that it's perhaps more important to think about the traits of the investments that you want to make, and instead of thinking about what are the sectors that I really truly want, because these things actually change over time. Like for example, if you are talking about say travel, before COVID happened, it had this beautiful long-term tailwind in demand. That for donkey years, travel numbers were growing at about 4 to 5% per year, very reliably, even during the great financial crisis of 2008 and 2009. But then COVID happened and everything just crumbled, right? So I think these things happen. So I think it's more important to just think about the characteristics of the investments that we want, rather than just focusing on the sectors. Yeah.
Yeah, that's a great answer. I think we have run out of time today, so that sums up our Q&A section. I hope for those attending, you have learned a thing or two, or many more, when attending this session. Yeah, so this is just to wrap up, right? This ADDit Investing Academy, this is just the first of many series of webinars aimed to educate the investor community and to make people like you more savvy and understand what you're investing into. So thanks, Ser Jing, for your time. I think that people really learn a lot from this, and your very insightful views have even taught me a lot, even as a moderator. So thanks for that.
No, it's absolutely my pleasure. And I just want to end and say that please do not take what I say to be gospel. Think about what I've said and question what I say, compare it to what's really happening in the markets, right? And I think this is the best way for all of us to learn.
Yes, thanks, Ser Jing. And to add on, right, investing is a personal journey. So every investment decision you make is ultimately yours. So always do your own due diligence and understand what you're investing into. Yeah, just to reiterate in our disclaimer that this is not something This is not an event that we're trying to sell anything or solicit anything from the audience. It's really purely educational purposes. So just to give you a heads up, our next event will be very interesting as well. It's about the future of private market unicorns in a post-pandemic world. We actually have a highly distinguished speaker who has been covering the startups and unicorn space for a large part of his career, and yet we'll have more event details to come. In order to find out what's happening next week on Thursday, just go to iSTOX.com/events to find and register yourself for the next event. We can guarantee that you will learn a thing or two as well, and I think we'll look forward to having you in that session. If there's nothing else, thank you very much, and we hope you enjoyed our session where it's about an investor strategy in a post-COVID world. Thank you.
Thanks again, everybody, for having me. Been an absolute pleasure.
Thank you. Have a good night.
Good night, everyone.